All right, welcome students. Today we are diving deep into one of the most critical topics on the balance sheet, liabilities. Now, I know it's a word we see all the time, but what does it really mean? We're going to go beyond the textbook definition to understand the why behind the accounting, from a simple IOU all the way to some of the toughest judgment calls an accountant has to make. So, here's our roadmap for today. We're going to break this down into 5 key parts. First, we'll build the foundation by defining what a liability actually is. Then we'll look at how they're classified, where they come from in day-to-day business, how they're used for financing, and finally, we'll tackle the really tricky stuff, how to account for them when the future is, well, uncertain. Okay, so let's start at the very beginning. Before anything can even get on the balance sheet as a liability, it has to pass a test. Think of these as the gatekeeper criteria. This is the foundation for everything else we're going to talk about. And here it is. This is the official definition. And the good news is, it's used globally by both IFRS and US GAAP. So what you're looking at is basically a 3-part test that every single potential liability has to pass. It has to be a present obligation, it must come from a past event, and it has to require a future outflow. Let's break that down.
The big takeaway here is that this is an all-or-nothing deal. An item has to meet all 3 of these criteria. A maybe future obligation doesn't count. An event that might happen next year doesn't count. If you don't actually have to give something up in the future, you guessed it, doesn't count. You have to check all 3 of these boxes.
So once we've decided, yep, this is a liability, the very next decision is a big one. Where do we put it? Is this a short-term problem or is it a long-term commitment? And believe me, the answer can completely change how we look at a company's financial health. This is also where we see a major difference between IFRS and US GAAP.
This slide really gets to the heart of a philosophical difference. On the left, you've got the IFRS approach. I want you to think of this like taking a photograph on December 31st. Whatever exists in that snapshot on that exact day is what gets reported, period. But on the right, you see the US GAAP view, which is more like a short video. It allows things that happen after the snapshot, like a deal signed in February, to actually change the story. Let's see how this plays out with an example.
So under the very strict IFRS rules, Global Manufacturing Corp has a current liability. It doesn't matter that they fixed the problem in February. The balance sheet has to show the cold, hard, legal reality of what was true on December 31st. And on that day, they did not have the right to put off paying that loan.
But now, if we put on our US GAAP hat, we get a totally different result. That new loan agreement in February is allowed to reach back in time and cure the classification. Why? Because it proved the company had both the intent and the ability to refinance. So same company, same set of facts, completely different balance sheet. Pretty wild, right?
Okay, so this table boils it all down for you. This is what you need to remember for your exams. IFRS is strict. It is all about the legal rights that exist at the reporting date. US GAAP is a bit more flexible. It allows events that happen after the reporting date to influence the classification. And what that means in practice is that a company can sometimes look a lot more liquid under US GAAP in these exact situations.
All right, let's shift gears. We're moving away from the big financing deals and into the liabilities that are just part of the daily pulse of a business. These are the operational liabilities, the ones that, keep the lights on and the inventory on the shelves.
Now, this might seem like a small detail, but it has huge financial consequences. When a supplier offers you terms like 210 net 30, they're saying, hey, I'll give you a 2% discount if you pay me in 10 days instead of 30. If a company decides not to take that discount just to hold on to their cash for an extra 20 days, well, that's the same as taking out a loan at a shocking 44.6% annual interest rate. It's an incredibly expensive mistake.
This table gives you a really clean way to separate the 2 main types of these day-to-day liabilities. Think of it this way. Accounts payable is for a bill you've already received. The amount is certain, it's sitting in the mail. Accrued expenses, on the other hand, are for benefits you've already used up but you haven't gotten the bill for yet. Think about salaries for your employees for the last week of the month. You owe them the money, you just haven't paid it. It's the matching principle in action.
Okay, now we move from that operational stuff into the world of formal financing. This is where we talk about things like promissory notes and bonds, and this is where the accounting can get a lot more complex, especially when a loan tries to pretend that interest doesn't exist.
Let's walk through a classic accounting problem you're absolutely going to see. A company issues a note that says right on its face that it has 0 interest. Now, as accountants, our skepticism alarms should be going off. Does that really make economic sense?
And right here, this is the core principle. There is really no such thing as a truly interest-free loan from an independent party. Lenders are not in the business of working for free, so the interest isn't gone. It's just hidden inside the face value of that note, and it's our job to find it.
So how do we do that? We have to use the time value of money, the present value formula. We take that future payment of $100,000 and we discount it back to what it's worth today, using the market interest rate. And that tells us that the real economic value of this liability on day one is only about $75,000. The difference, that almost $25,000, that's the hidden interest cost over the life of the loan.
This schedule is simply the roadmap for how we systematically recognize that hidden interest. Each year, we calculate the interest expense, but we do it based on the note's carrying value, not its face value. That interest then gets added back to the liability, which makes it grow, or amortize, over time until it perfectly hits that $100,000 face value right when it's due.
All right, for our final section, we are venturing into the most judgmental, most difficult area of liability accounting. What do you do when an obligation probably exists, but you're just not sure about the exact amount or the timing? Think lawsuits, product warranties, things like that.
And here we go again with another major split in philosophy. To book a liability for an uncertain loss, IFRS uses a more likely than not threshold. That's basically just over a 50% chance. But US GAAP uses the term probable, which accountants generally interpret as a much higher bar, somewhere around 75 or 80%. This lower threshold under IFRS means companies often have to recognize potential losses much earlier.
And the differences don't stop at just when you book it. Even if both systems agree a liability should be on the books, they measure it differently. So if you have a range of possible losses, say from $1 to $5 million, and there's no single best estimate, IFRS tells you to use the midpoint. But US GAAP, in that exact same situation, takes a more conservative route and says you can only book the lowest possible amount in the range.
So let's wrap this up and recap the critical points. We started with one single definition of a liability, but we've seen over and over how its application leads to some major differences between IFRS and US GAAP. This is especially true when it comes to classification and dealing with uncertainty. If there's one thing to take away, it's that IFRS is often more proactive, pushing companies to put potential liabilities on the books earlier and sometimes at higher amounts.
And this leaves us with a final, really important question that gets to the very philosophy of what we do as accountants. There isn't a single right answer here, but it forces us to think about the ultimate goal of financial reporting. Is it better to warn investors about a potential problem early on, even if it's still uncertain? Or is it better to wait until that loss is almost a sure thing? That's a debate that is right at the heart of accounting theory.